Greetings from our team at Robare Jones Wealth Management. This is Jack Jones, the managing partner, with our August monthly market update. Before we begin, we want to thank our clients for the trust and confidence that you place in us. The best part of our day is time spent directly serving you. So there remains a lot going on in today's market environment. We'll try to talk about a few high points. We'll begin with kind of this that we've talked about before, which is in this area is kind of what we're feeling now, but this is kind of a market cycle with emojis as the prompt. And at the top of markets, you feel euphoric. At the bottom, you feel anywhere between anger and depression. And the irony is when there's most to lose is up here, and when there's most to gain is here. It never feels like it, but we'll talk about that a little bit more later. So the first half of the year was a pretty lousy one with the S&P and bear markets, a lot of that driven by tech and consumer discretionary, with the one bright spot being the sector nobody wanted in 2020 and 2021, which is energy. Some big names in the first half of 2022 that were down significantly: Netflix, Amazon, Shopify, etc. And then came July. And so July, what's interesting is that it's the fourth best July going back about 90 years. So what does that mean for the back half of the year and other years where July has been a good year? After the top 10 Julys, which again, we're in the fourth best July going back to 1932. The 5 months that follow, on average, 6.7%. When July was just positive, 5.3, and when July is negative, 2.9. So as one data point item, this tends to be positive, a positive setup for the rest of the year. So we'll be talking about the midterms in the not too distant future. So it's important to look at how markets have performed during a midterm cycle. All years in the market, first 6 months versus last. So there tends to be kind of a end of the year kind of natural market cycle, but it's even more pronounced in midterm years. On average, you're flat the first 6 months, and then you have a rebound the last 6 months. So this continues to be our visual look at kind of where the Fed is in the tight spot between not bringing us into a recession, which we'll talk about in a second, and curbing inflation. So we have seen us go into the most commonly used technical definition of a recession, which is the preliminary read on Q2 was a negative 0.9 following a negative 1.6, 2 consecutive quarters. So we are in the most common definition of recession. As we look at recessions going back to 1926, on average, the average recession takes about 12 months, and the average expansion is about 5 times that at about 61 months. So there's not just the length of recession, but how big it was. So you see during the Great Depression, you saw a 27% decline. A pretty significant recession during the pandemic, although that was quickly reversed kind of with the reopening trade. The recession that we're in now, if truly this marks a recession, is a pretty mild one thus far. So how do markets do both during and after a recession? On average, 3 months before, during, and then 1 and 3 years after. So while painful and kind of not great market performance during and before recessions, on average, much better returns 1 and 3 years after. The other big issue that the Fed is dealing with is inflation. Our most recent read on inflation is 8.5 on a year-over-year basis. Now, that's good news in a way, in that it's not 9.1, but it's still a 4-decade high. Which brings us to kind of the two things that you don't want together, which is a kind of an economic slowdown and inflation, which is kind of the environment that we're in today. On the other end of kind of the economic look is jobs, which continue to be strong. This was more than double what was expected in July. So the unemployment rate is at 3.5. average hourly pay, which again isn't matching inflation, but is up 5.2. However, labor force participation ticked down. So there's fewer people working now than were pre-pandemic. But nonetheless, this is a much better job report than was expected. And it's very good news. So we have a tug of war in the economy between two negative quarters of contraction versus a really hot employment market. So this is a look, we've talked about this before at kind of the top 10 stocks and their impact on indexes like the S&P 500. And what you'll see here, if we look at the cap weight of stocks in the S&P 500, the top 10 take almost a third. Now, that would be okay if their earnings match, but they don't. So there's now kind of a dislocation between the cap size and the forward earnings expectations on those top 10 stocks. We've talked about this chart a lot. This just kind of tells us that we should expect, on average, about a 14% decline intra-year. So far, the worst this year is -24, although we've cut that about in half. Bull and bear markets, just looking back at history, going back almost 100 years, on average, where bull markets are 51 months and 162% cumulative return on average. Bear markets, none of them fun, but again, about a fourth of what bull markets are up and about less than half of the amount of time. This just talks about the time frame for owning different investment types, which looks at kind of 1, 5, 10-year and 20-year rolling time periods. What this in essence says is that stocks from peak to trough are too aggressive to own over a short period of time, but they're what you should own 5, 10, and 20 years. So part of the kind of the overall wealth management approach is hiring the right assets to meet the right goals. And again, if you have stocks for a 1-year period of time with a worse loss on a 1 year at -39, that's too aggressively invested. And then it's just this, we take this longer view as we kind of look at markets overall. This goes back to since 1926, the 96 years of market returns. And you see 71 positive, 25 negative. And the average positive return is about 2 to 1 what the average negative is. So all of these years are painful to go through. But again, the positive side is almost 3/4, and the upside return versus the downside return is about 2 to 1. So you did see us rebalance in June. We'll likely rebalancing again in the next 2 to 3 weeks, and we'll send trade notes out in advance to tell you the kind of themes that we'll be investing in. So these type of videos are no substitute for contacting us about how any of these items apply to you specifically. So if you have any questions at all, please reach out to us, call us, we're here to help. So with that in mind, we'll close. We try to keep these relatively brief. We hope for those in Houston that you have you find some coolness wherever you are, and we look forward to seeing you in the very near future. Until we see you again, take care.